Welcome to this week's market wrap-up. We're breaking down the top events that have moved the markets and what they could mean for the bigger picture. If you find value in here, please share this with your friends, as your support helps me to keep delivering these deep dives. Now let's go ahead and jump in. So, this week we had a ton of events happening on the macro side, but the most important part was that Donald Trump has reignited the tariff war, which is something concerning to many. Personally, I don't think about this all too much, especially that we've seen flip-flops so much over the last couple of months, daily changes in headlines and on a daily basis. So Trump has announced that he will implement 50% tariffs on the European Union and that they are non-negotiable. So he won't be looking for any sort of tariff deals to be made with the EU. Now, of course, he said that the US has a deficit greater than $250 million a year, which is a reasonable amount. Now, of course, it is way bigger than that, but a couple of zeros were missed there. I think he meant 250 billion. Now 250 million wouldn't be so bad, but it is not the real amount. The point is with these tariffs, how do these tariffs impact the US economy or the European economy? The point is tariffs tend to have an inflationary tendency because corporations pass costs directly to the consumers, so they keep their profit margins intact. Now, when we have that artificially raises the prices. And I think that has also translated to a lot of uncertainties for the Fed, which is why the Fed doesn't really know where their monetary policies are headed next. So they want to be somewhat conservative on them. Now, there's also a very interesting thing on that, because tariffs can also be deflationary, which may sound counterintuitive if they bring prices up. The point is, if consumers are tapped out, then the demand for a particular product simply drops because consumers no longer afford that particular product. Case in which tariffs become deflationary as consumption rates simply drop. Therefore, there isn't the problem of inflation, but there is the problem of an economic downturn and a recession. So that's what the Fed currently fears, I think, and this is also what has been translated on the yields, as we'll cover in a few minutes. But the point is, and the point I'm trying to make is, we want to pay attention to these sort of stuff, not just from this headline basis and how it impacts the markets on a day-to-day basis. Because we have a lot of short-term volatility, we have a lot of short-term noise that tends to emerge on the timeline, on the charts, and so forth. That's not what we want to pay attention to. What we want to pay attention to, however, is how do these things impact the long-term horizon and the long-term outlook for the markets. That's what we want to pay attention to. So moving to the CME Fed Watch tool, we currently have a 94% probability of seeing another rate hold in June. And looking at the probabilities, we see that the first rate cut is currently priced in September with a 47% probability, but there's also a 40% probability of another rate hold. This has been my base case for many months now. If you guys remember what I was saying back in early April, when the markets were crashing and everyone was screaming for an emergency rate cut, I publicly said that we won't be seeing a rate cut because the Fed doesn't want to bring inflation back. I believe that Powell has, let's call it a PTSD from 2021, when the Fed has overstimulated the economy, when the Fed has done that major mistake of overstimulating the economy, leading to a 9+% inflation rate in the United States, which is astronomically high. And I think that Powell doesn't want to repeat that. So instead of trying to make some sort of change in his monetary policies, he'll wait this out. He'll wait to see how the dust settles with all of these tariffs uncertainties, before making any sort of changes. Now that's very important to note there, because as long as the Fed keeps their monetary policies stable, that can lead to a risk on period in the markets. And I know I've made this argument before, but I think it's one of the most important things out there. The monetary policies and how they impact the price action. A lot of people seem to be afraid that yields have been staying relatively strong. So here we have the 10-year yields, which we see have been going higher over the last couple of days. And a lot of people don't know why. Why are yields going higher? Why are yields so strong? And there are a lot of arguments to be made here, don't get me wrong. There are a lot of arguments to be made here, but I think that the most likely outcome is the easiest one, which is that yields have been so strong because the economy is still resilient and doesn't need Fed's intervention. And that's a positive indication that has also been translated in the price action of the markets, as we've seen a major bull market over the last few years. And this range is essentially the same range we've seen for the last 2 years. So there isn't something new to this. It is just the same range yields have been in for the last 2 years. Each time there has been any sort of volatility on the short term, of course, a lot of people start believing in the idea that when yields are going higher, that can lead to a liquidity crisis in banks. When yields are going lower, that can lead to a recession because it leads to Fed's intervention. Now, we all know that yields have the tendency to front run Fed's policies, which is another important argument to be made here. As long as yields continue to remain high, it signals that there are no rate cuts in the near future expected by the markets, which once again is a positive indication. Seeing no changes in monetary policies is a positive indication. Let me put this into perspective. The intervention of the Fed would imply that the path that the economy is on isn't sustainable. Any sort of change in monetary policies implies just that the path isn't sustainable and that there needs to be a change. That's what an intervention from the Fed implies. It isn't bullish for the markets. That leads to uncertainties and leads to a lot of questions that are being raised by market participants. Why does the economy need Fed's intervention in the first place? What underlying problems is the Fed trying to solve? There are a lot of questions that are being raised when the Fed eventually intervenes, and that leads to market corrections. That doesn't lead to pumps, that doesn't lead to rallies, or if it does, they are very short dated. So as the saying goes, be careful what you wish for, because changes in monetary policies would imply just that. Seeing no changes in monetary policies and a stable macroeconomic environment is what we want for the markets and is what leads to these risk-on periods that lead to higher prices. So these are my thoughts on yields staying higher for longer. I've seen a lot of comments from people that high yields lead to corrections. So let me show you the charts, because these are just objective data points. Not opinions, not biases. These are just objective data points. What we've seen the last year, what we've seen throughout 2024 and 2023 was stable macroeconomic environment, was stable monetary policies, and that has led to this risk-on period. Now you might say, okay, this rally was led by technological advancement or AI taking over or things like that. But if we think about the underlying cause of that, what has led to technological advancements, what has led to the development of AI was investments. And where do investments come from? Well, they stem from a high degree of risk appetite, which is only created by a stable macroeconomic environment. Now, back in 2023 and all throughout 2024, we've seen just that. We've seen essentially a Goldilocks environment, which represents a period of high economic growth, relatively low inflation rate, and a resilient labor market, indicators which we still have. We still have a relatively low inflation rate, we still have a resilient labor market, and you might say that the GDP isn't as high as it used to be because it came in negative for the fourth quarter of 2024. But that is something that I would argue with, because we've seen a negative GDP growth rate in the fourth quarter of 2024 because there has been a massive spike in imports, as corporations had all of these pre-tariffs imports before the tariffs were implemented and before there were these artificial surges in prices, which we discussed earlier. They imported raw materials and everything that they need, so they have some inventory, and that has led to a lower GDP for the fourth quarter of 2024. So we still have all of the indicators and all of the macroeconomic data that we have had back in 2023. And we've seen exactly what uncertainty does to the markets. We've seen that back in March and April, when there were a lot of uncertainties regarding the macroeconomic environment, regarding the monetary policies that have led to this very aggressive sell-off. This is what uncertainty does to the markets. And you might say, okay, but we had uncertainties regarding a bad thing. Well, let's now go to 2020. How did the markets responded when we had this major drop in rates, when the Fed has reduced rates like everybody currently wants? Well, they dropped. We had this very aggressive sell-off because, once again, changes in monetary policies isn't the cause. Changes in monetary policies is the effect of the economic environment. So the Fed isn't the cause, but I believe the Fed is the effect that treats an underlying problem. So that's how I think of the Fed and of the macroeconomic environment. The macroeconomic environment is the cause and the Fed is the effect. So if we have the effect being to change, to cure something, then it means that they're trying to cure a problem. And back in 2020, that's exactly what they did. They tried to treat the underlying problem. We also had a very strong narrative around this, about COVID, and therefore the markets dropped. If we look at what happened when the Fed was actively cutting rates, we see markets were in this consolidation phase. They weren't really doing anything. They're just chopping around. There was a lot of volatility, no clear direction. The place where the markets have started to rally, guess what? Was just after the rates have consolidated here. When the rates were consolidating here, when the Fed has, once again, stable monetary policies, that leads to a risk-on period in the markets. That leads to higher prices. This is exactly what investors were betting on here. They were betting on the idea of a soft landing. They were betting on a stable macroeconomic environment. That leads to a higher degree of risk appetite, which leads to higher prices. So this is the whole thesis around the Fed and around yields. And also the fact that a lot of people seem to be highlighting yields being bearish for the markets. So yields being high, being bearish for the markets, is, I think, a good indication. I think it gives us a good opportunity to be a contrarian to how most feel about this, and to say that no, yield staying high is a positive indication, because it means that the Fed doesn't need to intervene in the economy. And also, we know that yields front run the Fed. So as long as yields stay strong, we won't see rate cuts. So that's how this whole thing works. Now, I've seen some posts on this, that rate cuts are bullish. Once again, I've shared my thoughts on rate cuts and what they imply for the markets. Rate cuts aren't bullish for the markets, but the phase that precedes them is. The environment leading up to it is. And let me explain to all of you what that means in practical terms. Rate cuts, once again, treat an underlying problem. Rate cuts imply that we need to see a change in the current path that the economy is on, because that isn't sustainable anymore. But the environment leading up to it, leading up to rate cuts, is in fact bullish, because it gives the market participants the opportunity to speculate on this idea. To speculate that we may see rate cuts, that rate cuts are bullish for the markets, that we will finally see new liquidity entering the markets, cheap capital, and so forth. So it gives all of these opportunities to speculate. Speculation is, in my opinion, one of the strongest factors in the markets that either drives prices really low or it drives them really high. And I expect that we'll soon enter this period of irrationality in the coming months that will lead up to a major rally and an emotional gap, which is a thesis we'll cover in just a few minutes. But these are my thoughts on rate cuts. The markets are foreseeing, and that this narrative will at some point become mainstream, that rate cuts are coming, that new liquidity will enter the markets, that a soft landing is next, that the Fed has finally did it. That's when I think we'll enter a distribution phase, but at that point it will be too late for everyone to adopt this mindset. Now is the time. So when everybody fears something, when everybody fears this, yields, for example, when everybody talks about yields being bearish for the markets and the fact that we will not see rate cuts in the near future and so forth, or that, you know, the bond market is unstable, the credit market is unstable, all of these bearish narratives, that's when we want to adopt the mindset of being bullish. Same as in early April. If you guys remember what I was saying back then in these exact weekly market wrap-ups, I emphasized that that was a good time to buy. I even made a post saying that I had the lowest cash positions since the 2022 bear market lows, because it pays to be a contrarian to the mainstream sentiment. It is just how things work. It is the objective reality. When everybody talks about the same stuff, that thing is priced in. So when people aren't talking about this, people aren't talking about rate cuts coming in the near future, or think that rate cuts will be the catalyst that will push the prices higher. So before we have rate cuts, prices are going to consolidate. After we have rate cuts, the markets are going to go higher. When people think like that, that is when you want to be a contrarian to how most feel and say that no, the environment leading up to the rate cuts is the one that is truly bullish and rate cuts are bearish, which is how I'm feeling right now. And the reason is, once again, as I highlighted earlier, when we see rate cuts, that isn't bullish for the markets because the Fed needs to intervene. But instead, the environment leading up to rate cuts is bullish. And that's also what I expect. So as I showed you earlier with the CME Fed Watch tool, the markets are currently pricing in the first rate cut in September. So that gives us some really nice time to speculate. So you see how much time this gives us. I expect that when the Fed will continue holding their rates in the coming months, this will lead to a risk-on period similar to the one we have saw back in November, back in 2023, and all throughout 2024. But now I expect that the main spotlight will be on risk assets instead of traditional equity markets. So instead of seeing this rally in equity markets, I expect that we'll have a blow-off top in risk assets. And this is a thesis I've covered many times before on why I expect this. I also don't exclude the possibility where equity markets form a new all-time high, though I think it's so this is not a scenario that I exclude, that equity markets form a new high before they start off this consolidation phase. I don't exclude this. Personally, I believe that it's likely we'll have this complacency phase developing with equity markets failing to form a new high, while liquidity will start flowing into the risk assets. That has been my base case. I'll show you in a few minutes the exact post I made back in early early April on this, the exact thesis I've said. So this is not something new that I'm highlighting just now. This is something I've discussed for many months now and has helped me to identify the bottom and to accumulate. The reason is on this. This has told me a very nice story about the risk appetite and how it has impacted the markets. This is the IWM to SPX pair. This shows us how small caps perform against the traditional equities in the S&P 500. And it essentially shows us how risk assets are performing against the traditional and safer assets. So we have the small caps, which have a more volatile business model and whom are greatly impacted by the monetary policies, because small caps always need cheap financing and low interest rates in order to grow their operations. Now, this is something that we'll get on and that I've discussed many times before, as I think this has also impacted Bitcoin miners deeply, because we have seen a quantitative tightening environment over the last couple of years. This has led to low financing because capital wasn't as accessible as it has used to be, and also interest rates were elevated. Therefore, these small caps, because the industry itself is so competitive, they need capital. So they need other ways to attract capital, and that I think is through dilution. By diluting their shares, small caps attract financing, and that way they can grow their business operations to keep pace with the competition. And that's why I think that small caps have underperformed their traditional peers over the last couple of years. So essentially, since the Fed has started to step away from their quantitative easing measures back in late 2021 and 2022, when they also started to raise their rates, that's pretty much where we've seen this 4-year bear market starting. Right where the Fed started to transition away from their quantitative easing measures. Now, this is an important argument to be made here. When we have quantitative easing, we have also a risk-on period in the markets, because once again, it affects small caps and risk assets in general, both from a fundamental perspective, because capital is more accessible, risk equities and risk assets can grow their business models more faster and more efficiently without needing to dilute investors, so the stock price doesn't suffer. And also we have the impact on the risk appetite of investors. That is one of the most important things out there. The risk appetite of investors is what really drives these small caps. When there is a high degree of risk appetite, that leads to these rallies and outperformance of small caps. Because, once again, investors are willing to take risks as they seek gains. But that is also caused by speculation. So they need a strong narrative that they can speculate on. Back in 2021, of course, there was the quantitative easing narrative, as the Fed was full on blasting liquidity, as we see here, and entering liquidity in the financial system, which of course leads to more capital being more accessible, low interest rates. Therefore, it automatically leads to a higher degree of risk appetite. Now, however, since they stepped away from their quantitative easing measures, we have seen the exact opposite, which is risk appetite going lower and lower and lower, and small caps massively outperforming their traditional peers because their business models suffered, but also there was a smaller risk appetite that was at play. Therefore, the traditional and safer assets have performed better than these risk assets. And this concept also applies for Bitcoin and its correlation to altcoins. We've seen altcoins massively bleeding against Bitcoin over the last couple of years because of the same reason. Because of the same reason between the correlation of traditional assets with risk assets. But now I expect that when the Fed will eventually step away from their quantitative tightening measures, so we'll have pretty much the exact opposite of what happened back in 2021 and 2022 when they have stepped away from their quantitative easing measures. Now we'll have, instead of seeing the total assets top out, we'll see the total assets bottom out. And what do you think will happen to this pair, to the IWM to SPX pair, when the number one factor that has led to this underperformance will go away? Well, I think it's pretty clear what it will have, and that is outperformance. So small caps starting to outperform their traditional peers, leading to this risk on period in the markets that eventually precedes the bear market. Now we can also talk about how this all plays a role into how liquidity plays a role into all of this. And we might come to the conclusion that market makers want people to have a very high degree of risk appetite as we near or as we approach a bear market or a cycle top formation, because of course they need liquidity to distribute. So that is also an argument to be made here. That is also why alt seasons only happen in cycle top formations, because that is when we have the highest degree of risk appetite. But that is also what leads to these cycle top formations. So it is a cause-effect relationship. Does the cycle top lead to a very high degree of risk appetite, or does the very high degree of risk appetite lead to a distribution phase and a cycle top formation? I believe it is the latter one, where we have the very high degree of risk appetite leading to the distribution phase, as it allows market makers to distribute. So that's also why I think it's likely that we'll see this phase developing, moving forward, that will eventually precede this bear market. So I want us to have a brief discussion about this post I made back in early April. This is the exact post I highlighted here. You can see here 5th of April. This is the chart I shared. Back then, as you guys might remember, there was a lot of chatter around the decoupling phase between Bitcoin and the S&P 500. So we had the S&P going down while Bitcoin was pretty strong. A lot of people highlighted this. A lot of people thought, Bitcoin has finally decoupled from the stock market. Okay, things are great. But I said that on the short term, I didn't think that would have much of an impact. But instead, the real impact would be on the midterm. And that divergence was a clue to where liquidity will flow next. Meaning that it showed us exactly where liquidity will flow next in the next couple of months. And this is why I highlighted in the first place this thesis around this complacency phase and risk on environment, because everyone was talking about it here. Everyone thought that it would have a short-term impact on the markets, but I thought it would have the real impact on the midterm. And once we'll enter this complacency phase, that's where Bitcoin would go much higher, because we would have this risk on period. So that's why I highlighted this. And this is a thesis, once again, I've covered for many months now, that once the S&P 500 sees its relief rally, we'll enter a complacency zone. And look what happened to the S&P 500. We've had this relief rally, and now it seems like we're entering this complacency phase. Once again, we may have new highs before we eventually start off this distribution phase. But nonetheless, I think that all of this will eventually lead up to this distribution phase, which would also coincide with a complacency phase that leads to risk on environment. And do you know when the economic downturn finally hits? It hits right when everyone believes that the bull market is back. It hits right when everyone is euphoric and everyone is excited and everyone has a very high degree of risk appetite. That is when we have the real economic downturn and the bear market. So that's how I see the market moving forward and the decoupling phase with Bitcoin. Now, you guys can see how this has played out right here. Okay, so we've had this relief rally in the S&P 500, and it seems like this is the same chart I highlighted then for Bitcoin and as well as for the S&P 500. It seems like we're decoupling, and I highlighted this on my X account as well, that Bitcoin seems to be decoupling from the S&P 500. So if we take out all of these drawings, we see right now that Bitcoin has remained strong while the S&P has been going down over the last couple of days. And on the short term, once again, I don't think this plays much of an impact. I think that on the short term, both are extremely correlated, and that Bitcoin mostly acts as a leverage play for the S&P 500. Though I think that on the long run, we'll have the S&P forming lower highs similar to this, while Bitcoin will form higher highs. So we see exactly what I'm currently talking about on a high time frame basis. Okay, so zoom out a little and you find that Bitcoin has formed a new all-time high while the S&P is still about 3% from reaching its prior all-time high. So that is an indication, I think, that liquidity will flow into risk assets in the coming months, and is a confirmation to my thesis I've covered many weeks now of this decoupling phase between Bitcoin and the S&P 500. Now that is what I want you guys to understand, that all of this will eventually lead up to a bear market. So we must never get trapped in the short-term noise. And this is a very important takeaway for this weekly market wrap-up. All of this will lead up to a bear market and the distribution phase. So if my thesis is correct, and it might very well be, this doesn't lead to anything positive. So yes, there will be a lot of money that will be made in the next couple of weeks, but that will also come with very high risks of seeing a bear market and more volatility. Now, more and more volatility is also what I think will happen moving forward with equity markets as well as risk assets. Volatility is likely to spike as we near the cycle top. That is what we know, because volatility is what gives market makers the opportunity to trade without having a major impact on the price action. So we've seen this happening back in 2022 here, and we've seen it happening back in 2021 and early 2022. This was a distribution phase. This was an accumulation phase. Do you see what has preceded it? Do you see what has coincided with this? It was volatility. A lot of volatility, a lot of liquidity traps that developed, which lead, of course, to more volume that is being traded. More volume is what gives market makers a counterparty to trade with. Therefore, that is what they want. So they'll bring volatility in the markets to shake out, first of all, leverage investors, so they have the most liquidity, but also they have a very high spread of bid and asks. So the swing high and the swing low, the bigger it gets, the more volume that is being traded. That is basically how this concept works. So when we'll enter this distribution phase, I expect a lot of volatility. And remember, this comes with narratives along the way. Narrative that would change on a daily basis. Narrative that would lead to both euphoria as well as uncertainty. But investors still betting and doubling down on their bets to try to chase the gains. Because once again, keep in mind that in this time, prices will keep going higher. So of course, there will be this FOMO sentiment, this fear of missing out sentiment from retail investors in particular. Even with headlines changing on a daily basis, and I expect at the time to have most narratives around the end of quantitative tightening, additional rate cuts that will come, the potential of a soft landing, and all of these positive narratives that fuel the risk appetite of investors, but also a ton of volatility, which is why we want to avoid leverage. Leverage in the next couple of weeks will be extremely detrimental to everyone. And you might say, okay, no, leverage is what gives traders the opportunity to trade on a short-term basis. Yeah, okay, you do that, and you'll see what happens to that. We see hundreds of millions being liquidated on a daily basis. Every single day, there are hundreds of millions of dollars that are being liquidated in the perpetual markets on a daily basis. Do you know why? Because we have leveraged, over-leveraged investors. And I expect them to grow in the next couple of months because the risk appetite will be higher and higher. Do you know who is the real winner from leveraged positions of retail investors? First of all, exchanges, because exchanges and the house always wins, right? We have exchanges that win through fees. The more leverage there is, the more funding rates exchanges get. So first of all, we have exchanges. Second of all, we have market makers. Market makers use leverage positions as a counterparty. Market makers hunt leverage positions and the places where the most liquidity is, because that's how they, first of all, have a counterparty to trade with in large sizes, and second of all, they can make profits by counter trading it. So that's who the real winners from this story are, not the retail investors. As retail investors, and let me tell you something, I have worked with people who use high frequency trading. You can win against that. Trading on a short-term basis, day trading or anything along those lines is just pure betting. And I'm saying this from experience. I have tried it all. I have day traded, I have swing traded, I have been an investor for many years now. What I can say is that being an investor is the most profitable outcome possible for retail investors. On a long-term basis, you cannot outperform the markets. You can try to, of course, but you will, in most cases, will not be able to do that. Because you win on a short-term basis, you win a lot more than you would win, by holding, but you also lose. By investing and choosing your companies in a good fashion, by analyzing their fundamentals, by analyzing the broader environment, by analyzing the industry, you cannot lose on a long-term basis. Which is why and there is also the stress factor. By holding, you don't have stress. And to many people, it may be a variable to take into account. Most of us have families. Most of us have other things that we have to do rather than trading. So that's an important note to take. Not a lot of people think about the personal side or the human side all too much, but I think that's also what we should really focus on when we invest. Before we invest in a company or an asset or anything, we want first to think if that particular asset fits to our own personal goals and fits to our own personal judgments and needs. If it doesn't, then we risk having this divergence between what we want and what we need. Therefore, there have been a lot of people who have invested in risk assets. So I remember a lot of people investing in altcoins or investing in Bitcoin. back in 2021 right at the top because they saw the volatility to the upside, but they didn't think about the volatility to the downside. So they got shaken out. Of course, they lost a ton of money from that. But that's the main point I wanted to make. Before we make an investment, think about whether that fits your own personal needs before you think about it from an economic perspective on how many profits that asset can bring you. So moving to our next point for the day, for this conference, is the manipulation in the crypto market. Let's talk about liquidity traps. So we've discussed about the volatility side, we've discussed about how market makers use retail as a counterparty and how they create an artificial counterparty to trade with by creating these very volatile times. Let's talk about what has objectively happened over the past months. This is a thesis I have invented myself. So you might call it crazy, you might say that it cannot play out, possibly, but it did. It did, and I've used it times and times again to hedge myself at range highs, then to scale out of my protective shorts and scale back into my spot holdings. This is the strategy that has allowed me to accumulate over the past months, while traders got wrecked, while a lot of investors also got wrecked as they saw their portfolios going down. This is a strategy that has kept me alive, let's say. So what is this strategy? It is pretty simple from practical term view, but it is more complicated rather, if we analyze it deeply and see what it implies. But I'm going to explain it to all of you today. Essentially, this is a post I shared back in late March, when we had all of those uncertainties and fears regarding tariffs. The reason why we've had those uncertainties and fears regarding tariffs in the first place, and why Trump has flip-flopped with tariff headlines on a daily basis before eventually he just chose not to do so anymore, was because it has helped market makers to accumulate. What we see here is the series of untapped lows that have developed on the low time frames. And then some news or some event comes out that leads to these liquidation cascades. Each time there has been a liquidation cascade over the past few months, what preceded it was this series of untapped lows developing, leading up to this crash. The reason why these series of untapped lows develop is that we have liquidity levels stacking up on top of each other. We have lots of retail investors setting their stop loss right at the nearest low. So you see here, if for example I would take a long position here, I would set my stop loss right at the nearest low, which would be this one. So we have these liquidity levels that stack up on top of each other that eventually lead to a liquidation cascade. A liquidation cascade is what allows market makers to get all of that liquidity to trigger all of those stop losses. And if we think about what a stop loss of a long position means, it represents a forced sell order. Therefore, it is the perfect counterparty for market makers that are trying to accumulate. And back in late March, I also highlighted the series of untapped lows developing on low time frames that of course have led to the liquidation cascade back in early April. And we can clearly see how they have developed. So you saw that post, you saw these liquidity levels, then we had this liquidation cascade, and then it bottomed. Right after all of the liquidity got swept, it magically bottomed. So moving to the charts, now I want to present you a new thesis I've developed over the last couple of days, and I've shared it on my X account as well as on my YouTube channel in one of my prior videos, is around an emotional gap that could develop in the coming weeks, and that I think is already in play. So let's see what this emotional gap thesis implies. First of all, the first time I've covered this thesis was back in September of 2024, when we had an extreme sentiment of fear. We've had a lot of capitulation. A lot of investors thought that this was the start of the bear market. Of course, back in August, we had the yen carry trade crash. As we all remember, a lot of people calling for a black swan and a recession at that point. But they were wrong, and they were overcautious here. Then, after this sentiment of extreme fear, we've had this sentiment of disbelief. The sentiment of disbelief is very interesting to me, because we've had this initial bounce from the lows here, but nobody believed that that was the true reversal that would lead up to new all-time highs. There were a lot of bears who at that time waited for too many confirmations, such as new all-time highs, which would invalidate, of course, their bearish thesis. But they waited for too long after increasing their cash exposures here to position themselves for lower prices and for a potential bear market. They waited this out. They didn't load on this initial bounce from the lows. So this was mainly a disbelief rally. Let's call it a disbelief rally, where sentiment of disbelief takes over. Nobody believes that is the true reversal. They wait for too many confirmations, or in the worst case, they even try to short it. They try to short this rally thinking that we're headed lower and that this is a dead cat bounce. But eventually what this leads to, so this transition from extreme fear to a state of disbelief, then we have an emotional gap finally playing out. An emotional gap is this very rapid transition from the state of disbelief to a state of full-blown euphoria, where the bearish thesis gets invalidated and everyone acknowledges that bears were wrong, bulls were right, now is the time to buy. That is what an emotional gap brings. Extreme fear of missing out. So extreme euphoria. That is what an emotional gap brings. And we've seen this happening once again in November. But at that point, unfortunately, for many people, it was too late. They have missed out on the rally. And at that point, the distribution phase was already in play. And this was essentially the distribution phase. We can confirm this with many on-chain data indicators, which we'll cover in just a few minutes. But this is how this has developed. From extreme fear to disbelief to this emotional gap and then full-blown euphoria. And it all comes down to liquidity and to the risk appetite of investors. If we think about this, if you think about how this has worked, we had market makers who accumulated here at these levels. Then nobody really bought because, a lot of disbelief, nobody thinking that was the real rally. Not a lot of people have really bought and acknowledged that their bearish thesis was wrong. Now, ego is also what plays a major role into all of this. The fact that not a lot of people are able to acknowledge that their thesis has been invalidated. This is also why we want to keep objective levels set in place that would invalidate a thesis, and why we want to have an objective strategy and plan that we stick to. This is the most important reason, because at some point we're gonna have ego at play, our own ego, to acknowledge that we are wrong and that we need to embrace the new market reality and face the harsh reality that we have been wrong. Therefore, we want to keep that in check. We want to leave emotions aside, and we want to have an objective strategy that we stick to and objective levels that once crossed, our thesis gets invalidated. But not a lot of people do that, and that's why there are so many losers in this market. But don't forget, for each loser there is a winner. And most of the times there are a lot of losers and a few winners in this market. Market makers usually win while retail loses. which is why it's so hard to keep pace with everything that happens in the markets. And this is also why it's so hard to outperform the markets on a long-term basis. Once again, I think we can do that by investing in the right industries and the right companies in the first place, in the right asset classes, and being invested for a longer period of time. Now let's get back to this thesis. Let's see how the current period currently correlates to what we've seen back in October and November of 2024. We've covered the liquidity traps. We've covered how market makers have used retail as a counterparty, how they've used all of the liquidity traps to accumulate, and how they've managed to fool retail into shorting the bottom. Now, right where we had the sentiment of extreme fear back in March and back in early April, that's where a lot of people have capitulated and have increased their cash positions to prepare themselves for lower prices. Now, on the other hand, it seems like we've had a similar period of disbelief. So, not this period, but what happened here, for example, before we crossed above new all-time highs, when a lot of people have publicly acknowledged that they were wrong and that because new all-time highs were made. But this phase of impulses up and consolidation phases, do you know why we didn't have any substantial pullback over the last couple of days? Why instead of seeing a healthy market structure and normal market structure, I could say, of having an impulse up and then a clear corrective move before the next impulse up, we didn't have that because that would give sideliners and retail investors who have increased their cash position at these levels the opportunity to buy back lower. So instead, we've had these shallow consolidation phases that have preceded each of the impulses up so far. And as we'll cover, we can confirm this by using the on-chain data, as each time there has been a consolidation phase like this, funding rates moved into negative territories, signaling that a lot of people were shorting in this consolidation phase, thinking that we were headed lower. So normally, because they were shorting, because they were betting on the idea that we were headed lower, of course they weren't buying, right? So it means that we have been in a similar disbelief phase to the one we've had back in November. Okay, so to the one we've had here, where we had this move to the upside marked by disbelief after seeing the extreme fear from August and September of 2024. So it seems like we're having the same playbook once again of extreme fear, disbelief, and now market makers could finally trigger this, could finally bring some sort of catalyst that could lead to market euphoria. Once again, we need to have a very strong narrative around all of this. If we have this major move to the upside, we need to have a very strong narrative attached to this. Back in November, we've had a very credible and very strong narrative around Trump. How Trump was to pump the markets because he was elected as president. Now I think this will correlate to the end of quantitative tightening, additional rate cuts, and the potential of a soft landing. That's what I think will push the prices of assets much, much higher. As this narrative becomes mainstream, it will fuel the risk appetite of investors and lead the markets into this full-blown euphoria phase where everybody wants to buy, where everybody wants to FOMO in. And this also correlates with the broader concept of distribution to risk assets that I've covered earlier, with the S&P 500 entering a complacency phase that would lead up to this blow-off top in risk assets. Now that, of course, would precede this distribution phase in the markets and this complacency phase that would develop later on that would lead up to a bear market. But at that point, I think we'll finally have the distribution out of Bitcoin into altcoins. And this is where I'm trying to get to the Bitcoin dominance. So this is also a post I highlighted back in early April. The reason why I've accumulated back in early April, and this is the post where I publicly said, you can see here, 4th of April, that I had the lowest cash positions since the 2022 bear market lows. So this is something I publicly acknowledged. Not some hedge posts, not some up and down chart, nothing. I publicly acknowledged that I had the lowest cash positions since the 2022 bear market lows. Near zero cash I had back in early April. Because, as I said here, it's not because it's easy, but historically moments like that, when the markets are irrational and over-leveraged traders are getting margin called, have been the best times to buy. That is why I bought. That is why I have accumulated. But one of the main factors that has gave me the confidence to accumulate was in fact the Bitcoin dominance. This is our next topic of the day. The Bitcoin dominance moving higher. Over the last couple of years, what we've seen is a lot of people hoping for an alt season, a lot of people wishing for one, a lot of people saying that altcoins were to outperform and that we were finally entering the next expansion of altcoins. And we've seen that repeatedly over and over again throughout 2023. Each time we have seen a correction in the Bitcoin dominance, everyone started to hope for an alt season. All throughout 2024 and so forth. The thing is with alt seasons, an alt season coincides with a cycle top formation. So calling for an alt season is the same thing as calling for a cycle top. Personally, I started to believe in this idea back in December and back in late November of 2024 when we've seen this major crash in the Bitcoin dominance. Bitcoin was also at some key levels I highlighted back in December, the $100,000 to $110,000 range, which in my opinion was a good range to have a cycle top formation based on some metrics I was tracking at that point. Therefore, I started to believe in the idea of an alt season. And this was the first time in 2 years of having Bitcoin in majority in my portfolio where I started to believe in the idea of an alt season. And I started to buy into a lot of altcoins. So the first time I did that was back in November and late October, where I made some videos around this, that we were to see an alt season. When we saw the Bitcoin dominance crashing, I said, okay, a lot of profits were made. I secured most of them back in December. There were some clear bearish confluences forming, so I de-risked a lot of my portfolio. But at that point, I thought, the cycle top was in, and that is pretty much it for this bull market. Bitcoin has reached its distribution phase. We will have an alt season, and then later on, distribution phase and a bear market. So we've had this initial crash. Then I called for a bounce to the upside. We've had the bounce to the upside, and then I said, okay, now we're headed lower. The distribution phase continues. Altcoins are going to outperform, and the cycle top is in. But that was when I was wrong. That was when the Bitcoin dominance kept on going higher. And the point where I realized I was wrong was when this wasn't what led to this major correction in the Bitcoin dominance. But instead, the Bitcoin dominance kept going higher. And as I said earlier, as long as the Bitcoin dominance keeps going higher, it signals that liquidity is still flowing into the traditional assets. And it signals that liquidity is still flowing in the assets that tend to provide long-term and reliable gains. What that implies, and that tells a very interesting story, I believe that all of these pairs and all of these and the Bitcoin dominance tell a very interesting story about the risk appetite of investors. As long as the Bitcoin dominance keeps going higher, it signals that there still isn't enough. There still isn't degree of risk appetite high enough that would lead to cycle top formation. As I said earlier, the cause to effect relationship between the risk appetite and the cycle tops. The cycle tops aren't what lead to a high degree of risk appetite, but instead a high degree of risk appetite leads to cycle tops. So if you don't have this factor, if you don't have this variable included in the markets, then we don't have a cycle top and we have nothing to worry about. And this is something I've said back in March and early April, and this is what gave me the confidence to accumulate and to publicly state that I had the lowest cash positions since the 2022 bear market lows. The fact that the Bitcoin dominance moved higher is what gave me this confidence. So as a takeaway for all of you, as long as the Bitcoin dominance goes higher, it is a sign of strength in the markets. It is a sign that liquidity is still not flowing into the risk assets that would normally outperform in a distribution phase, but instead they are following its normal path. That is a bullish indication. That is what gives me confidence. Instead, when the Bitcoin dominance goes lower, as I expect in the coming weeks, it signals that the risk appetite of investors is increasing. Therefore, that is a warning indication that we want to pay attention to. So we get to our next chart, which is Bitcoin and the total 3. And we see here exactly how altcoins, which are reflected in the total 3, perform against Bitcoin. An important note here is that Bitcoin has formed new highs, which we see here, while the total 3 is still far away from doing so. So looking at this chart, it has a very clear indication on how Bitcoin has outperformed altcoins over the past few weeks. So Bitcoin has formed a new all-time high while altcoins are still pretty much at 25% away from forming a new one. And that, I think, is just another indication that Bitcoin is the king of the crypto market. Bitcoin is what leads altcoins. Now, when you see this chart, you think, okay, altcoins have dumped normally with Bitcoin, but still, I think we could enter a bear market because this time is different. This time is always different, by the way. This time is always different than previous cycles. Unfortunately, the reality is quite the opposite way. Most of the times, history tends to repeat, but in other forms. And I thought to myself this, well, if altcoins go lower, then it means that we haven't yet topped out for this cycle. Because if we look at what happened back in 2022, when we topped out, or rather back in 2021, when we had the actual distribution phase of the bull market, see what happened here. When Bitcoin was consolidating, so we had a similar phase to the one we've had back in November. A similar volatility phase. And also this just is another confirmation of what I was saying earlier around volatility. How volatility spikes in cycle top formations or in distribution phases as it allows market makers to distribute. What I was saying here was that while Bitcoin was in this distribution phase, liquidity was flowing out of it. So the Bitcoin dominance was, of course, crashing. And while the price of Bitcoin didn't really do much, we've had altcoins massively outperforming. That is an indication of a real distribution phase. Because once again, a distribution implies that there are liquidity outflows. So liquidity coming out of that asset, which of course makes other assets rally, because liquidity always needs to go somewhere. Liquidity, it doesn't disappear once it is taken out of an asset. It goes to another one. So we want to track these cross-market confluences in order to understand where liquidity could flow next. Or if it does go, if it flows somewhere, what story that tells. If it flows into altcoins, what does that mean about altcoins and about the risk appetite of investors? So that's what we want to focus on. And back in 2021, that is the story told about the risk appetite, how it went parabolically high. Everyone believed we were headed higher, and of course, a lot of people got trapped. That is also what I expect to happen in the next couple of months. We'll eventually have this emotional gap that will develop and the distribution phase that will lead up to a major alt season in the coming months. Now, historically, we see that alt seasons have coincided with each cycle top so far. Back in 2017, it has coincided with a cycle top. Or back in 2022, it has coincided with a cycle top. So you see how the others dominance has kept going lower and lower, while at each correction, at each range low for Bitcoin throughout this cycle, at every consolidation range so far, we've had people who started to believe in the idea that the cycle top was in. The cycle top will not be in until altcoins massively outperform Bitcoin, until we see something like this in the others dominance and full-blown euphoria everywhere. I don't expect the cycle top to be in. And you might say that no, this time is different because of ETFs, because liquidity is now invested into ETFs rather than Bitcoin, and now liquidity will not flow into altcoins anymore. Okay, we can agree to disagree, but cycles say other things, conferences say other things. And if we think about this from a fundamental level on why altcoins outperform, right when we approach the cycle top formation, it makes a whole lot of sense why we would see an alt season before we have the bear market, because a very high degree of risk appetite is what leads to these alt seasons, and a very high degree of risk appetite we know now that precedes cycle top formations, or that it coincides with distribution phases. So now we learned something new. So the story about ETH to Bitcoin, it is pretty much the same of altcoins to Bitcoin. It is the story on how altcoins perform against Bitcoin, and generally we know that Ethereum tends to lead other altcoins, essentially. Therefore, we want to pay attention to what Ethereum does so we understand what the rest of the altcoins will do. What we saw is that over the last couple of years, the ETH to Bitcoin pair has bled. So Ethereum has bled against Bitcoin and has massively underperformed. My argument for this is the same I've used for the IWM to SPX pair, that risk assets have underperformed against the traditional and safer assets because of quantitative tightening. And we see exactly how this has played out. When the Fed has started to step away from their quantitative easing measures back in late 2021 and 2022, so they started to reduce their balance sheet, they started to increase the interest rates and so forth. That has led to this distribution phase in the ETH to Bitcoin pair. And then later on, when they have fully adopted a quantitative tightening environment, that's also where we've seen this bleed of Ethereum against Bitcoin happening. And if we look at what happened in the prior cycle, we've had a very similar correlation to the one we're seeing right now, where we've had this quantitative tightening environment in play while the ETH to Bitcoin pair was bleeding, and Ethereum was massively underperforming Bitcoin. Do you know when that has stopped? Well, right where the total assets of the Fed bottomed out, and right where the Fed stepped away from their quantitative tightening measures. That's also where the ETH to Bitcoin pair bottomed out. Therefore, I see no reason why we wouldn't have the same outcome once again, where the Fed finally steps away from their quantitative tightening measures, the total assets bottoms out, and we have a bottom in the ETH to Bitcoin pair once again, which precedes the next alt season and this major outperformance from altcoins. So these are my thoughts on altcoins. I know a lot of you are interested in them. And speaking of risk assets, I want us to have a look at Bitcoin miners. I also know that a lot of you are interested in my perspectives on Bitcoin miners. A lot of you have asked me why I haven't updated Bitcoin miners in quite a while, or specifically why I don't cover them on a short-term basis. There are so many ways I can reiterate the same things over and over again. So I've covered the confluences I've been tracking since early January, and pretty much the two scenarios I had in mind for Bitcoin miners. So you can see here this post was made back in early January, where I highlighted two potential scenarios that could take place. The first one was my bullish scenario, which was at the time my base case, which implied that we were in a corrective wave 2, similar to the one we have been in November of 2023, that has preceded this major move to the upside, when this corrective wave 2 has also came really close to invalidation. So I made this argument that we may be seeing this corrective wave 2, which came in really close to invalidation, which precedes the next impulses to the upside. So I said, okay, that is my base case. Now the second scenario, where things would be a little darker for Bitcoin miners, would have been the one where we broke up below the September lows, essentially flipping the whole high time frame market structure. And how this would look like, instead of seeing this final impulsive wave 5 on the high time frames to the upside, we would have instead have this major A correction that will later on lead up into this complacency phase, and then later on into continuation into the bear market. That is the invalidation scenario highlighted from early January. So this is not a new concept I'm highlighting just now, but it is the same strategy I've had for many months now. Of, if we see a break below the September lows, that triggers my invalidation scenario, where Bitcoin miners would most likely have topped out for this cycle, and that the next move up would be this complacency phase that would develop from there on. But I also said in this exact post that if that happens, I won't panic sell and at the range lows after everyone has capitulated already. Instead, I'll wait for the exit pump to come, and then I'll sell most of my spot holdings. And this concept doesn't apply only to CleanSpark, which is the one I highlighted here and the one that we'll cover today, but it applies to all Bitcoin miners that have broken their high time frame market structure. And most of them have. So now moving to the charts, let me show you what I'm currently thinking right now. We have seen, so the post I made was here. I highlighted a potential move to the upside, followed by another move to the downside, which we've seen. We've seen also a break of the lows, of the September lows. Therefore, that acts as a invalidation for my bullish thesis I've covered then. Which means that it's likely that Bitcoin miners have topped out for this cycle. Here, the top from March of 2024, and that the next move up will be this complacency phase that will develop, that precedes the bear market. That is my current base case. But as I always emphasize, it's best to stay ready for multiple scenarios to take place. And this is something I highlighted in my latest videos on Bitcoin miners as well. If we have clear bullish confluences that could invalidate this thesis, and it very well might be invalidated because of the thesis I've covered earlier around the risk-on environment that would lead to the outperformance of small caps against the traditional equities in the S&P 500. Now, of course, a massive role is played by the non-systemic risk that miners carry, and that is how they dilute their shares and how they use dilution to attract financing. So a major role is played by that and cannot be quantified by tracking the broader performance of small caps. So how miners perform in the coming months will be individual to small caps, I believe. And we've seen this correlation more or less happening on the high time frames as well. Bitcoin miners have underperformed even the IWM for some time. So what we want to pay attention to is both the industry that Bitcoin miners are operating in, which is the small caps, and we want to think about all the things that small caps bring, which is high risk involved, which is volatility to monetary policies, and a lot of exposure to monetary policies rather because of their volatile business model. And we also want to take into account the fact that these small caps dilute. Therefore, we cannot hold them for a long period of time. So these are my thoughts on Bitcoin miners right now. If they do not dilute, that's a big if. If they do not use this move up to attract financing and to grow their business model, then I think we could see this bearish thesis being invalidated. Meaning that we could have this move to the upside and then later on a distribution phase that will later on precede a continuation into the bear market. But there are a lot of ifs to this invalidation scenario. So first of all, we must have a lot of strength coming in from buyers. We must have the risk on thesis in play, which might very well be in play, as I highlighted earlier. There are a lot of conferences that are pointing towards this direction. And second of all, and third of all, actually, and this is one of the most important conferences out there, the network has become very competitive. The global hash rate is hitting new all-time highs almost on a weekly basis. The global hash rate is currently sitting at 1,000 exahash per second, which is an enormous number. The global hash rate has grown exponentially over the last couple of years, which only implies that the competition is fierce and that these Bitcoin miners need to grow their business model at a pace that is much faster than the one it used to be. And as I mentioned earlier, the macroeconomic environment doesn't prime growth for small caps for two main reasons. The first one being the fundamental reason that it doesn't prime their business model as a whole, and the second reason that it doesn't prime investments to these small caps, as investors do not want the risk associated with investing in these small caps. So there are a lot of ifs to this invalidation. Therefore, I'll track the upcoming data. The first point that we must get through in order to think about this invalidation scenario being in play is crossing above this major resistance range, which we see has acted as a major reversal point in the past. So back in 2024, it has acted as this major support range. Then once it broke down, it has acted as a major resistance range, once again as a support range, and once again as a reversal point back in January and February, where we've had a continuation back to the downside. So this will be the first place that we want to get through before we even consider the idea of an invalidation. Once we approach these levels, I'll start being cautious. As I highlighted in that post, the range for my de-risking is currently sitting at $14 to $18 for CleanSpark. Now personally, I don't see any reason to cover in videos each miner individually. There are a lot of miners out there, but the concept remains the same. There are just different numbers on the screen that we want to pay attention to. So the concept remains the same. The concept of the cycle top being in, and now we're in this complacency phase that will develop later on, lead to this brief distribution phase that will precede a continuation into the bear market. And as I highlighted in that post in early January, this is a very unfortunate scenario for us, but it also has a very important value attached, and that is the learning part. I personally have learned a lot of things from the mistakes I've done. I personally have learned a lot of things on how small caps perform against traditional equities, how the macroeconomic environment impacts them. Some of the things I've I've relearned. So there are things I knew, but now that I've experienced them, I understand them completely. So knowing something and understanding it, I've learned now that are two different things. So I think that even though miners have underperformed, even though I have made less money with them than I would have wanted to, I think that the lesson I've learned is invaluable, and that moving forward, by applying all of the informations I've learned, will be more profitable than I could have ever been by making profits with these miners. And I think that's how each mistake should be treated. Each mistake should be considered as a very valuable lesson and as an opportunity to become better. And that's what I think Bitcoin miners have bring me. Even though if they did not lead to a lot of profits, especially over the last couple of months, they have definitely led to a lot of lessons that have been learned, both by me as well as by every investor in these Bitcoin miners. So I hope that if you've done the mistakes I've done, that you don't take this as a bad thing that has happened, but as a good one, because you have learned something invaluable that will help you in the future to become a better investor and better at choosing the sector that you invest to, the companies that you invest to, the strategies that you use, and so forth. So these are pretty much my thoughts on Bitcoin miners. As I said in that post, if we would have this invalidation scenario playing out, I would not sell here, because that is the dumb thing to do, to sell after everyone has capitulated already and sell after, it already dropped. But instead I kept accumulating and I stick to my strategy. From the profits I took here when I de-risked my whole portfolio back in November and all throughout December, I managed to accumulate throughout this dump and throughout these months of correction. By hedging at range highs and then scaling out of my protective shorts, I also managed to DCA back into my spot holdings. Therefore, I managed to lower my overall entry price by a lot over the last couple of months. Now I'm sitting on a pretty nice profit that I look forward to take once we approach this important resistance range. When we'll approach it, I'll de-risk naturally, and then I'll wait for additional conferences to see whether this thesis ends up playing out, the one with the complacency phase ahead for Bitcoin miners, or the one where we invalidate this thesis and we actually form a new high before we eventually have a transition into the bear market. So these are pretty much my thoughts on Bitcoin miners. So let's now discuss about Bitcoin itself. The king. The time has finally come to talk about Bitcoin. Looking at the interest, even though the price is currently at an all-time high, the interest is nowhere near the levels it has been back in November or back in March of 2024. So even though the price is currently sitting above $110,000, the level of interest is nowhere near the one it has been when we were at $73,000. And that is an interesting fact, because it signals that it is most likely that will go higher in the coming months, which will make retail come back, which will make the levels of interest also go back up as we approach the cycle top. So as I said earlier, I don't think it's likely that we have topped out now. A lot of people seem to be highlighting this, seem to be making a lot of correlations between now and what happened back in 2021, 2022, when we had a sweep of the highs with made that impulse up to $69,000. So let me actually show it to you on a chart. Okay. So a lot of people seem to be saying that we're repeating this, where we had this correction, then we had this sweep of the highs, which eventually led to the bear market. A lot of people say this, though I think it's very unlikely that this will play out. As I said, on this exact chart, the correlation between altcoins and Bitcoin could not be any different from what happened back in 2021 and 2022. Therefore, I don't think the correlation between these two periods is accurate. So I personally don't use it. As we see here, the interest was also much higher than it is right now. Because of that reason, I think that we're headed higher in the coming months before we eventually have a distribution phase and the markets roll over. And a confirmation of this, and a very interesting thing that has really caught my attention, and it's somewhat counterintuitive, you may think. Funding rates are still below 0.01% on most exchanges. So we see here for Bitcoin the funding rates, which are very low considering that we're sitting at an all-time high. So the funding rates are really low considering that, which signals that we still haven't seen euphoria in the markets, signals that euphoria still isn't here, and that it's likely that we'll go higher in the coming weeks and months. So funding rates, as we'll cover in just a few minutes, we can use them both on a low time frame basis to predict shorter movements, and we can also use them on a high time frame basis to assess the broader cycle and the market sentiment. Most importantly, funding rates tell a very interesting story about risk appetite and market sentiment. When funding rates are this low, it signals that people don't really care. Therefore, prices will most likely keep going higher. When funding rates are high, it signals that people do care, people are euphoric, perpetual markets are taking over, therefore that is a good place to de-risk. So now moving to the Velo data. The Velo data, I know many of you are familiar with it. I cover it very frequently on my X account as well. I've made a lot of videos on how I use the Velo data. I use it in a lot of my videos as well. The Velo data is very interesting because it helps us to understand what really happens behind the scenes, what happens behind the price action and the charts. And I've used it when we were throughout these ranges. So I told you a couple of minutes ago, that when we were in these consolidation phases, funding rates, as you guys can see here, flipped into negative territories, which signals that investors were bearish. Investors were betting on the idea that we may have a drop or that we may have a continuation to the downside. So all of that fits into my disbelief rally. That this was a disbelief rally, that not a lot of investors got to buy on this move to the upside. Therefore, they didn't really get to reinvest the cash they took out here at these range lows when everyone was anxious. So it's a really nice way to see and assess some confluences that develop on the charts. And then we see here that they flip back into negative territories, so market makers have flushed them and have squeezed all of the shorts out of the market. And now we're seeing the opposite starting to play out. We're seeing this major spike in open interest, meaning that more and more perpetual positions are piling in, so more and more leveraged positions, while funding rates are in positive territories. So on a high time frame basis, funding rates are low, as I emphasized earlier, but on a low time frame basis, if we want to use funding rates and how they correlate with the price action and open interest, they are pretty elevated. Therefore, we might expect a short-term pullback in the coming days that would flush all open interest and all of these late longs that have been piling in over the last couple of days before we have a continuation back to the upside. Now, of course, this may coincide also with a corrective wave 2 from an Elliott wave standpoint, which is something I'll cover tomorrow in my weekend update in a more detailed version. So make sure you stay tuned for that as well. Also have the premium metric, which has flipped for a brief moment back into positive territories, which for me is a warning signal. Whenever the premium metric flips into positive territories, it signals that perpetual markets are taking over, and that so first of all we need to understand what the premium metric shows us. It shows the future prices minus the spot prices. So it essentially is an indication on what drives that move. If there are perpetual markets that drive that move, oftentimes that move, whether it is to the downside or to the upside, isn't sustainable because it is driven by perpetuals. So market makers trying to either flush shorts or flush longs. So that move automatically isn't sustainable. But if the premium metric is in negative territories, it shows us that spot prices are higher than the future prices. Therefore, that move is driven by spot activity rather than perpetual activity. So, meaning that that move is sustainable and that move is likely to continue, but we need to keep tracking the premium metric in order to see whether that move becomes a perpetual driven move, similar to what we had here when it briefly moved into positive territories before it flipped back into negative territories. We've had similar instances where this has happened. Back in late February when we were here, this has preceded this move to the downside, and back in late January as well when we reached this phase, this has preceded this move to the downside. And of course here, as I told you earlier, how that was a distribution phase because the premium metric was in deep positive territories, signaling that this was mainly a perpetual driven move and that a lot of longs were piling in, a lot of people were FOMOing into the markets. There was a very high degree of risk appetite. Therefore, that was a distribution phase that market makers have used to distribute. So that's how I correlate everything between the macroeconomic environment, the broader market analysis, the funding rates, the on-chain data, Bitcoin dominance, and many other metrics and conferences we have covered in this conference. So with that being said, as a takeaway, what I would like to emphasize is how important currently is to stick to our own strategy, because as we approach the cycle top, we should expect plenty of volatility. So stick to your plan, keep emotions and leverage in check, and most importantly, focus on the long-term trend. Do not lose sight of the bigger picture and do not get caught up into the short-term noise. So that being said, that's a wrap for this week's market wrap-up. So yeah, it has been a really insightful discussion. I hope you found it insightful, and if you did, please share it with a friend or make sure to spread the word about the work I do, because it truly helps a lot and truly supports me and keeps me doing these conferences for you guys. So if you've stick with me so far, thank you for watching all the way through, and I wish you all have an amazing weekend ahead. See you guys in the next one.